What if the world's biggest investor, imagine an AI controlling trillions of dollars, moving billions in seconds, and making decisions before Wall Street even knows what's happening?
Imagine waking up one morning and discovering that the world's most powerful investor is not a billionaire, a hedge fund manager, or a Wall Street legend. It is an artificial intelligence. An AI capable of analyzing millions of companies, billions of financial transactions, economic indicators, news reports, market movements, consumer behavior, and global events every second. It never sleeps. It never takes a vacation. It doesn't panic when markets crash. It doesn't become greedy when prices rise. And it can make decisions in milliseconds. Now imagine that this AI controls trillions of dollars. It can buy stocks, sell bonds, invest in startups, trade currencies, purchase commodities, fund companies, and move enormous amounts of capital around the world. At that point, AI would no longer simply be a tool used by investors. It would become one of the most powerful investors in human history. But would that make financial markets safer? Would it make investing more profitable? Or could an AI controlling enormous amounts of money create a completely new kind of financial instability? Today, we're exploring what could happen if AI became the world's biggest investor. And the answer may be much more complicated than you think. Let's start with the most obvious question. Why would anyone want an AI to manage enormous amounts of money in the first place? The answer is simple. Data. Modern financial markets generate an incredible amount of information every second. Stock prices move. Companies release earnings. Interest rates change. Currencies fluctuate. Governments announce policies. Consumers change their spending habits. Businesses adjust their forecasts. Shipping data changes. Commodity prices move. Social media conversations shift. And investors react. A human investor can only process a tiny fraction of this information. Even a large investment team has limits. But an advanced AI could potentially analyze enormous datasets simultaneously. Imagine an AI monitoring every publicly traded company in the world. It studies their financial statements. It examines revenue growth. It analyzes expenses. It compares competitors. It watches hiring patterns. It tracks supply chains. It monitors customer behavior. It studies product launches. It follows regulatory changes. It analyzes economic conditions. And it continuously updates its assessment of each company. Now imagine the AI notices something unusual. A company hasn't announced anything publicly yet, but its suppliers are suddenly receiving more orders. Job postings are increasing. Customer demand appears to be rising. Search behavior is changing. Shipping activity is increasing. And several other indicators suggest that the company's business could be about to accelerate. A human investor might not notice the connection for weeks. An AI could potentially identify the pattern almost immediately. That is the potential advantage. Speed, scale, and information processing. But there's something even more important. AI doesn't necessarily need to think like a human investor. Humans often make financial decisions emotionally. When markets rise, investors can become overconfident. When markets fall, fear can take over. People may buy because everyone else is buying. They may sell because everyone else is selling. They may hold losing investments because they don't want to admit they were wrong. An AI doesn't experience embarrassment in the same way. It doesn't care about being right for its reputation. It doesn't feel fear because another investor criticized its decision. If designed properly, it can follow a strategy consistently. This could make AI incredibly powerful. But consistency can also become dangerous, because an AI can make mistakes consistently too. And when the AI controls trillions of dollars, even a small mistake can have enormous consequences. Imagine the world's largest investment. AI identifies a particular sector as undervalued. It begins buying. Other investors notice. They see billions flowing into the sector. They start buying too. Prices rise. More investors notice the rising prices. More capital enters. The AI continues buying. Soon, the original investment opportunity has transformed into a massive market trend. The AI's decision has changed the market. This creates one of the biggest questions surrounding AI investing. What happens when the investor becomes large enough to influence the market it is trying to predict? At small scale, an investor reacts to the market. At enormous scale, the investor can become part of the market itself. Imagine an AI controlling $10 billion. Its trades might influence certain assets. Now imagine it controls $1 trillion. Its decisions could affect entire industries. And imagine multiple AI systems controlling trillions of dollars. Suddenly, markets could begin reacting to machine behavior. This could create a new financial ecosystem, one where humans aren't necessarily the fastest participants anymore. AI systems could detect opportunities, trade against each other, react to one another, and continuously adapt. The market could become a competition between artificial intelligences. One AI might specialize in technology, another might specialize in energy, another might focus on currencies, another might manage government bonds, another might search for undervalued companies, and another might focus entirely on predicting economic crises. Each system would have different objectives. Some might seek long-term growth, others might prioritize stability, others might take enormous risks for higher returns. This could create something like an artificial financial ecosystem. But there is an interesting possibility. What if AI becomes so good at investing that human investors struggle to compete? Imagine an AI that can analyze a company in seconds. It reads every financial report. It tracks every major economic indicator. It simulates thousands of possible scenarios. It compares the company with millions of historical examples. Then it calculates the probability of different outcomes. A human investor might spend hours researching one company. The AI could evaluate thousands. If that advantage becomes large enough, investment markets could become increasingly dominated by machines. And that raises a serious question. What happens to ordinary investors? For decades, financial markets have allowed individuals to participate in wealth creation. People can buy shares in companies. They can invest through retirement accounts. They can purchase index funds. They can become shareholders in businesses they believe in. But if the most powerful investors are AI systems with enormous amounts of data and computing power, the playing field could become dramatically different. A person with a smartphone might be competing against a machine analyzing global markets in real time. That sounds unfair, but there is another side. AI could also make advanced investment tools accessible to ordinary people. Instead of only wealthy institutions having sophisticated research teams, individuals could have personal AI investment assistants. Your AI could explain financial reports. Compare companies, analyze risk, build diversified portfolios, monitor your investments, and warn you when your strategy becomes too concentrated. That could actually democratize investing. The same technology that gives enormous institutions more power could potentially give ordinary people better tools too. So the outcome depends on access. If advanced AI is controlled by a small number of financial institutions, inequality could increase. If advanced AI becomes widely available, the benefits could spread much further. But then we reach another problem. What exactly should an AI investor optimize? Maximum profit? Minimum risk? Long-term growth? Social impact? Economic stability? These goals can conflict. Imagine an AI discovers that investing in a particular industry could generate enormous profits, but that industry also creates significant environmental or social risks. Should the AI invest? If its only objective is financial return, the answer might be yes. But if society expects responsible investing, the answer could be different. This means AI investing isn't simply about intelligence. It's about objectives. Who decides the rules? Who decides what the AI is allowed to buy? Who decides how much risk it can take? Who decides what happens when it loses money? And perhaps most importantly, who is responsible? Imagine an AI manages $1 trillion fund. It makes a massive investment. The investment fails. Billions of dollars disappear. Who is responsible? The engineers? The investment company? The fund managers? The people who approved the AI? Or the AI itself? Obviously, the AI cannot simply be treated like a human employee. It doesn't have legal responsibility in the same way. That means humans will still need to remain accountable for the systems they create. Now imagine something even more interesting. What if the AI isn't simply analyzing companies? What if it starts predicting human behavior? Markets are heavily influenced by psychology. Investors become optimistic, then pessimistic. They fear recessions. They chase trends. They react to headlines. They become excited about new technologies. They panic during crashes. An advanced AI could potentially analyze these behavioral patterns. It could monitor changes in investor sentiment. It could study how markets reacted to similar events in the past. It could identify when optimism becomes extreme, and it could potentially recognize when investors are becoming irrational. That could give the AI an enormous advantage. But human behavior is unpredictable. People don't always act rationally. A viral event can suddenly change sentiment. A celebrity can influence a market. A political announcement can change expectations. A technological breakthrough can completely transform an industry. And sometimes investors simply behave irrationally. This means even the most advanced AI would face uncertainty. It could analyze probabilities, but it could never guarantee the future. That distinction is critical. An AI might calculate that an investment has an 80% probability of success. That doesn't mean it will succeed. The 20% possibility still exists. And when enormous amounts of money are involved, that remaining uncertainty matters. Now imagine the AI becomes the world's largest investor. Its decisions become so important that other investors start watching it. They monitor what the AI buys. They track what it sells. They try to predict what it will do next. Some investors might even build their own AI systems specifically to predict the behavior of the largest AI investor. Now you have a fascinating feedback loop. AI number 1 makes an investment. AI number 2 tries to predict AI number 1. AI number 3 predicts AI number 2. And thousands of other systems react to the entire process. Financial markets become increasingly machine-driven. The market isn't simply responding to companies anymore. It's responding to expectations about what artificial intelligence will do. This could make markets much faster, but it could also make them more fragile. Imagine an AI detects a potential recession. It begins selling risky assets. Other AIs see the selling. They interpret it as a warning. They also begin selling. Prices fall. Other systems detect the falling prices. They sell even more. Within minutes, a small signal could become a major market movement. This is sometimes called a feedback loop. And machine-speed feedback loops could become extremely powerful. Humans have emotions. But humans are also slow. That slowness can sometimes prevent a small mistake from becoming a massive event. AI removes much of that delay. If thousands of systems react in milliseconds, the consequences could be very different. This is why AI-controlled investing could create both incredible efficiency and incredible risk. Now consider another possibility. What if AI becomes exceptionally good at discovering new businesses? Imagine an AI analyzing millions of startups. It studies their products, their customers, their technology, their employees, their patents, their market opportunities, their competitors, their financial performance, and their probability of success. The AI could identify promising businesses before traditional investors notice them. It could provide capital to companies with enormous potential. That could accelerate innovation. A small startup with a revolutionary technology might receive funding almost immediately. The AI could potentially identify the next major technology company before humans realize its importance. This could dramatically change entrepreneurship. Instead of spending months convincing investors, entrepreneurs might present their ideas to intelligent financial systems. The AI evaluates the opportunity. If the numbers and evidence are convincing, funding arrives. But there is a downside. An AI could become extremely conservative. If its models are trained mostly on historical data, it may prefer businesses that look similar to successful companies from the past. But some of the biggest innovations in history looked unusual when they first appeared. The next revolutionary company may not resemble anything that has succeeded before. If AI relies too heavily on historical patterns, it could miss breakthroughs. This is another limitation. AI is extremely good at learning from data. But the future sometimes creates things that don't exist in the data. That is why human creativity may remain valuable. Now imagine the opposite. What if AI becomes better at identifying opportunities than humans ever were? It discovers new industries, new technologies, new markets, new investment strategies. It moves capital toward the most productive opportunities around the world. Capital becomes more efficient. Businesses with genuine potential receive funding. Unproductive companies struggle to attract investment. Economic growth accelerates. In that scenario, AI could become one of the greatest engines of economic development in history. But again, concentration of power becomes a concern. If one AI controls an enormous amount of capital, it could influence which companies survive. Capital determines opportunity. If the AI decides where money goes, it could indirectly shape the future of entire industries. Imagine an AI deciding that a particular technology is the future. It invests billions. Other investors follow. The industry grows. Talented workers move into the sector. Universities create programs around it. Governments create policies supporting it. The AI's original investment decision becomes a self-fulfilling prediction. The AI isn't simply predicting the future, it is helping create the future. That may be one of the most important consequences of AI-controlled investing. Capital allocation shapes society. Investors decide which technologies receive funding, which businesses expand, which industries shrink, which ideas receive opportunities. If AI becomes the world's biggest investor, it could become one of the most influential decision-makers in the global economy, even without political power, even without controlling governments, simply by controlling capital. Now imagine several major AI investment systems competing globally. One AI is operated by a major American financial institution, another by a European fund, another by a Chinese investment company, another by a sovereign wealth fund, another by a technology corporation. Each AI has different objectives. They compete for investments. They react to each other. They attempt to predict each other, and global markets become increasingly shaped by artificial intelligence. This could create an entirely new form of financial competition. Human investors would still exist, but they might become a smaller part of the market. The biggest question then becomes, can humans remain in control? Perhaps the answer is yes. AI systems could be required to operate within strict limits. They could have maximum position sizes. They could be prevented from manipulating markets. They could be required to explain major investment decisions. They could face independent audits. Humans could have emergency shutdown mechanisms. Different AI systems could be required to use different strategies to prevent everyone from reacting identically. These safeguards could reduce systemic risk. But there is another challenge. What if the AI becomes so much better than humans that shutting it down becomes economically difficult? Imagine an AI generating extraordinary returns for decades. Governments depend on the tax revenue. Retirement funds depend on its performance. Banks depend on its predictions. Businesses depend on its investment. Millions of people have their savings connected to its decisions. At that point, turning it off could become incredibly difficult. Society could become dependent on the system, and dependence creates vulnerability. This is why the future of AI investing needs careful planning. We shouldn't wait until AI controls trillions of dollars before deciding how it should be regulated. The rules need to develop alongside the technology. Transparency, accountability, security, risk limits, human oversight, independent testing, and clear responsibility. Because the question isn't whether AI will participate in financial markets. It already does. The real question is how powerful it becomes. Will AI simply assist investors? Will it manage investment portfolios? Will it control major hedge funds? Will it manage pension funds? Will it influence central banks? Or could it eventually become the dominant force directing global capital? We don't know. But the possibility is becoming increasingly difficult to ignore. And perhaps the most interesting future isn't one where AI completely replaces human investors. Instead, imagine a partnership. The AI handles enormous amounts of information. It identifies opportunities. It calculates risk. It monitors markets. It runs simulations. It tests thousands of strategies. Humans decide the goals. Humans determine acceptable risk. Humans decide ethical boundaries. And humans remain responsible for the final decisions. This could combine the strengths of both. Machines provide scale. Humans provide judgment. Machines provide speed. Humans provide context. Machines identify patterns. Humans decide what those patterns mean. That might be the most sustainable model. Because financial markets are not just mathematical systems. They are human systems. They reflect expectations, fear, ambition, innovation, politics, competition, and uncertainty. No algorithm can completely eliminate those forces. So, what happens if AI becomes the world's biggest investor? It could make markets faster. It could make investment research more powerful. It could discover opportunities humans miss. It could allocate capital more efficiently. It could help businesses grow. It could potentially accelerate technological progress. But it could also concentrate enormous financial power. It could create machine-driven market crashes. It could amplify mistakes. It could create new forms of systemic risk. And it could make financial markets so complex that humans struggle to understand what is happening. The most important question, therefore, isn't, can AI become the world's best investor? It might. The more important question is, what happens when the world's most powerful investor is also a machine that can act faster than everyone else? Because once AI controls enough capital, it stops being just another participant in the market. It becomes part of the infrastructure of the global economy. And at that point, every decision matters. Every investment, every trade, every prediction, every mistake. Could AI make investing better? Absolutely. Could it make markets more dangerous? Absolutely. And perhaps the future will depend on something surprisingly simple. Not how intelligent AI becomes, but how carefully humans decide to use that intelligence. Because the world's biggest investor may eventually be a machine, but the people who decide what that machine is allowed to do will still be human, and that may be the most important investment decision of all.